In our last episode, we met the private limited company, a business with shares, but shares locked inside a small private circle. Today, that circle finally breaks open. We're going to meet the public limited company, the kind of company that you, or anyone at all, can actually buy a piece of. And this is a big one, because this is the exact moment the stock market begins. Let's quickly remember where we are. Every single structure we've studied so far, the sole proprietor, the partnership, the LLP, the LLC, even the private limited company, all of them hit the very same ceiling. None of them could sell shares to the general public. A private company can only raise money from a small, closed circle, the founders, some family, a handful of private investors. But what happens when a business becomes so successful and so ambitious that it needs truly enormous sums of money, far more than any small circle could ever provide? Money to build factories, to expand across the world, to fund gigantic ideas. To get it, the company does something dramatic. It throws open its doors and offers its shares to the entire public. That is the leap from private to public. So let's define it simply. A public limited company is a company whose shares can be freely bought and sold by the general public. And the place where that buying and selling happens is the stock exchange, a public marketplace built specifically for trading shares. We'll explore exchanges in much more detail later in this course. For now, the key idea is this. Once a company is public and listed, anyone can become a part owner. You, me, a complete stranger on the other side of the world, all we have to do is buy a share. This is the structure behind almost every famous company whose name you already know. Here's what changes most dramatically when a company goes public: the sheer number of owners. A private company might have just a handful of shareholders. A public company can have millions of them, scattered right across the globe. Its ownership is sliced into a vast number of shares, held by people who will never meet each other, never speak, and never set foot inside the business. So if the owners are millions of strangers, who on earth actually runs the company day to day? This is that separation of ownership and control we flagged last episode. And now it really matters. The shareholders own the company, but they elect a board of directors to run it and to act on their behalf. Ownership and control sit in different hands. But going public is not all upside. It comes at a real price, and that price is responsibility. When a company takes money from millions of ordinary members of the public, it has to be held to a much higher standard. So public companies face strict regulation. They are legally required to publicly disclose their financial results regularly and honestly, their profits, their debts, their risks, all laid open for anyone to see. And they're watched over by a market regulator, a powerful body whose entire job is to protect ordinary investors from fraud and deception. This is the fundamental deal of going public. You get access to the public's money, but in return, you must open your books to them. Transparency is the price of admission. Now let's put the two side by side, because the contrast is the whole point of this episode. First, who can own the shares? In a private company, only a small closed circle. In a public company, anyone at all, the general public. Second, are the shares traded on an exchange? Private, no. Public, yes, they're listed and freely traded. Third, how many owners? Private, just a few. Public, up to millions. Fourth, how much money can it raise? Private, limited, capped by that small circle. Public, potentially enormous. And fifth, regulation and disclosure. Private companies face lighter rules. Public companies face heavy regulation and must open their books to the world. Notice the trade-off running through every single row. Going public buys you access to vast amounts of money and a huge base of owners, but it costs you privacy, and it loads you with regulation. Neither one is simply better. They're built for completely different stages of a company's life. At this point, you might be thinking, if going public unlocks all that money, why doesn't every company just do it? And that's a brilliant question, because going public has real downsides. It's expensive and slow to arrange. It wraps the company in heavy rules and reporting requirements permanently. The founders can lose control because millions of new owners now have a say in big decisions, and every result the company posts becomes public, visible to competitors, to critics, to the whole world. For all these reasons, many wildly successful companies deliberately choose to stay private for as long as they possibly can. Going public is a powerful tool, but it is absolutely not free, and it is not right for every business. Picture the scene that captures this whole idea. When a company finally lists, its shares start trading on a stock exchange, a vast, fast-moving public marketplace where buyers and sellers meet every single second the market is open. Those flashing green and red prices you've seen scrolling across the news? That is exactly this. Each one is the live, real-time value of a public company, set not by any single person, but by millions of ordinary people, all freely buying and selling their shares. That is the living, breathing heart of the stock market, and it only exists because of the public limited company. As always, the same idea wears slightly different clothes in each country. In India, it's a public limited company, and its shares are said to be listed. They trade on the major exchanges, the NSE and the BSE. The whole market is overseen by a regulator called SEBI, whose job is to protect investors. In the United States, the equivalent is a public corporation, often carrying Inc. in its name, with shares trading on exchanges like the New York Stock Exchange and the NASDAQ. There, the regulator is the famous SEC. But look at the bottom rows. In both countries, the core duty is identical: regular, honest public disclosure, and the big idea is exactly the same. Open ownership for the public, balanced by strict oversight. Same principle, two flags. Let's pull it all together. 1. A public limited company is one that can sell its shares to the general public. The ceiling every earlier structure ran into is finally broken. 2. Those shares are listed and freely traded on a stock exchange. 3. It can have millions of owners, far too many to run it directly, so a board of directors runs it on their behalf. 4. In exchange for all that public money, it accepts heavy regulation and must regularly, honestly disclose its results to the world. And 5. The big lesson: private versus public is a genuine trade-off. You gain access to enormous capital, but you trade away privacy and a good deal of freedom. And with that, you now understand every major type of company there is. So here's where we go next. You now know every major type of company, from the one-person sole proprietor all the way up to the giant public limited company. But knowing the types raises an obvious practical question. How do you actually create one? How does a business go from being just an idea in your head to a real legal company on paper? That's our next chapter, and it's a fascinating journey. This is the market's story, from the basics all the way to advanced, one story at a time. If this finally made the stock market click into place for you, the idea of a company you can actually own a piece of, then please hit that subscribe button. It's completely free, and it's the single biggest way you help this channel grow and reach more people just starting out. Drop a like so others can find it, and tap the bell so the next episode comes straight to you. See you there.